In this video, we're going to go through a CFA Level 1 style question on computing the asset beta of a business, which is also known as the unlevered beta, hence the phrase unlevering a beta. This is part one of a two-part recording, which, when watched one after the other, will guide you through the process used to estimate beta for a company which is non-public or thinly traded, or perhaps is publicly listed but wants to move into a new line of business or industry. So please be sure to watch the next video on relevering the beta as well. Unlevering and relevering a beta is one of the more technical and demanding topics within the corporate issuers section of the Level 1 curriculum, and many candidates fail to grasp the logic behind it. So, if this is something you want to get right in the exam, keep watching and let's get solving. So, this is the question that I want you to have a go at. A publicly traded company which operates solely in the maritime transport industry has a marginal tax rate of 20% and a debt-to-equity ratio of 2. If the company's equity beta is 1.4, the asset beta of the business is closest to 0.47, 0.45, or 0.54. Okay. You should already know that beta represents the sensitivity of a stock's returns to market risk. That is the conditions prevailing in the market overall. Now, the beta that we may quite easily compute using data on returns on a stock versus the returns on a wide market index is actually known as the equity beta. And this is a measure of the sensitivity to market conditions as felt by the company's shareholders. Now, this is not only a function of the industry in which the company operates. As you will appreciate, some industries are more cyclical and thus have a higher beta, whereas others are more defensive, in which case they will have a lower beta. The equity beta is also impacted by a company's level of gearing or financial leverage. So, a high level of debt in the capital structure, and let's express this with the debt-to-equity ratio, so a high D to E, will cause equity beta to be high as well. In other words, the shareholders of a company with a high debt-to-equity ratio experience returns which are more volatile than those of companies in the same industry but with less debt. In bad times, debt proves a fixed financial burden which reduces profits. In good times, debt is a cheap source of additional capital to scale the size of profitable operations. In any case, what we must appreciate is that the equity beta, computed for any company on the basis of its stock behavior, is a function of these two factors. Now, what we sometimes want to do is evaluate a project in a specific industry which will be undertaken by a company that currently operates in a different line of business. So let me draw a company moving into a new industry. And we will therefore need to borrow the beta to be used here from another comparable company which is already in that new industry. So let me write comparable company, which is already in the new industry and which is publicly listed, so its beta may easily be computed based on publicly available information. Now, the reason you need to use a beta specific to the new industry is that it will allow us to correctly compute the rate of return required by shareholders given the level of systematic risk which the new industry exposes them to. However, if you just simply borrow the beta of that comparable company, its equity beta, you are taking a measure which inherently reflects not just the risk of the industry, but also the level of financial leverage specific to that comparable business. What we therefore need to do is first unlever the beta. So in this scenario, we've got a publicly listed company in the maritime industry with an equity beta of 1.4. The company is significantly geared with a debt-to-equity ratio of 2, implying that its unlevered or asset beta should in fact be lower than this 1.4. Let me write out the relevant formula. Asset beta is equal to, and please recall that this is also the unlevered beta, so the beta of the business as if it were 100% equity finance, equals the beta of equity, this one, times the weight of equity in the company's capital structure plus the beta of debt times the weight of debt, naturally, in that same capital structure. And if in the exam you are ever struggling to remember this formula, please think of a balance sheet. On the one hand, you've got assets, and on the other, equity and debt. So that's equity and debt, and over here you've got assets. Or think in terms of the beta of a company's assets being shared by its equity and debt investors. Now, very conveniently, we typically assume that debt, being a fixed income instrument, is insensitive to market conditions and accordingly has a beta of 0. So over here, let me say assume 0, which is what we typically do. And this leaves us with the expression which may be written as follows. Beta of the asset is equal to beta equity, or equity beta, times the weight of equity, which I'm now going to write out as E divided by D plus E. So the relationship between the amount of equity and the amount of debt and equity. But what we additionally do here is we multiply the debt by the tax shield. So let me say 1 minus t over here, just before the d term, or it could be just as well after the d term. That's our tax shield, 1 minus the tax rate. And that's because we are considering the impact of debt on a company's earnings. And the tax deductibility of interest reduces the debt burden and its effective impact on net income. That is the returns to shareholders. Now let's divide both the numerator and denominator of this fraction by E. And so we arrive at beta equity times 1 divided by 1 minus t times d over E plus 1. You should note that for a company with no debt, this produces an asset beta equal simply to its equity beta. In other words, if D is 0, i.e. no debt, we've got beta of equity times 1 effectively over 1. So let's now take the numbers from the scenario and plug them into this formula. For equity beta, we've got 1.4, naturally times 1, leaving 1.4. And in the denominator, I'm going to have 1 minus the tax rate. The tax rate was 20%. So 1 minus 0.2. Now multiply this by the debt to equity ratio, which was that pretty big number 2, and add 1. And let me now take the calculator to perform this computation. So I've got 1 1.4 divided by, and let me open up a bracket for the denominator. So I'm going to have 0.8 for the tax shield effect times 2 plus 1, close bracket, and I can see an answer appearing on my calculator of roughly 0.54, not 0.4, 54. And if we now check this against the answers, possible answers to the question, it seems to correspond very nicely with answer C.